Welcome back to the ROI Podcast, the podcast that's obsessed with the art and science of return on investment. And today, it is my pleasure to welcome back to the channel, friend of the channel, the Uranium Insider himself, Mr. Justin Huhn. Links to his newsletter, his epic newsletter, will be in the description. So I highly encourage you guys to check that out. And of course, the standard disclaimer, nothing that we say here is advice. It's just two guys having a chat, talking uranium, asado, and whatever else comes up over the podcast. Justin, pleasure to have you back on. How have you been, sir?
I've been really well. How about yourself, Benjamin? Good to see you again.
I certainly cannot complain. Let's dive right into it. We were talking just before we started recording. You mentioned something interesting has happened in Kazakhstan. What is it, Justin? What's going on over there in Kazakhstan? Specifically, what does it mean for people interested in uranium as an investment thesis?
So last week, the country of Kazakhstan announced new increased tax rates on uranium production. And this is pretty significant. The legacy tax rate has basically been a flat rate, I believe, of 6%, if I recall correctly. And they just announced a progressive rate and additionally a marginal rate. So, not a marginal rate. It's progressive, but not marginal. So the more you produce, the higher your tax rate is. And not only for the pounds that are above and beyond that cutoff for that particular tax rate, every single pound you produced will be sold and applied to that specific tax rate. So, and it's a pretty big jump, and it's going to kind of scale in starting next year. But just to give you an example, up to 500 tons of annual production is a 4% rate. Up to 1,000 tons is a 6% rate. Pardon me, the legacy rate was 4%. So if you're producing less than 500 tons, that in any given year, you'll continue to pay that 4% rate. Up to 1,000 tons, 6%, 2,000 tons, 9%, 3,000 tons, 12%, all the way up to 18% tax rate above 4,000 tons of production. And some of these larger projects potentially would have production in that range. So we're looking at a 3 to 4x in the tax rate that is going to be paid by some of these larger projects. Now, understanding that Kazatomprom is 75% owned by the Sovereign Wealth Fund of Kazakhstan, essentially state-owned, that for Kazatomprom themselves, this higher tax rate is sort of, money out of one pocket going into the other, in a way, right? But for the JVs, it's not the situation. This is a significantly higher tax rate they're going to have to pay. And in our estimation, this is going to have a few potential influences on the market. One of those is obvious. You're going to probably see higher uranium prices coming out of Kazakhstan. So for all of the sellers, that'd be Kazatomprom, Orano, Uranium One, CNNC, CGN, a couple of Japanese entities. Basically, all the joint venture partners and Kazatomprom themselves are going to have to raise their rates. And they're going to have to pass that increased cost that they're going to have to incur based on this higher tax rate onto their customers. So that's going to influence the price of uranium, which I think is a pretty simple assumption to make based on this. It's possible that these higher rates could disincentivize production ramping. That's entirely possible. It might influence on a 100% basis production out of the country to remain relatively flat going into the future. That's entirely possible. I don't have a strong feeling about that one. Obviously, the price is going to go up. Whether or not that's going to disincentivize production, they can still make a lot of money by increasing production, paying these tax rates, and passing that cost on to their customer, right? But I think the third potential outcome, and also one that I haven't really heard anybody discuss, is that this is going to be one more reason for utilities to accept the present and rising price environment for uranium. So you mentioned, before we hit record, that it's been very, very quiet in uranium. It has. We've been kind of in a stalemate price-wise since, mid to late February. We're going on 5, pushing 6 months almost of basically sideways action or chop between the low 80s and the low 90s per pound in spot. All that time, by the way, the term price has been marching higher. But that is to say that there's a little bit of a standoff happening right now in the market between utilities and producers. The producers are obviously wanting to sell into the market at these prices and or higher prices. So for term contracting, we're looking at floors in the, somewhere around the term price, high 70s into the 80s. Market reference contracts largely, floors in the 70s and 80s, ceilings 120, 130, right? Depending on the volumes, depending on the source, depending on the customer location, depending on the time period, et cetera. So there's a lot of gray area in there, but relatively speaking, that's what this environment has been in. Utilities aren't happy with that pricing environment. You can probably see that in the low volumes that have been contracted this year, 31.5 million pounds year to date. Okay. It's nothing. It's a very, very small amount of volume been contracted, and we can get into the reasonings for that if you'd like to. But one of those reasons is that utilities don't want to buy in high volume at these prices unless they absolutely have to. Because if you come in volume at these prices, not only is it probably going to put pressure to the upside, but it's also, in a way, admitting that you are accepting this pricing environment. So utilities and producers have been headbutting a little bit. There's other reasons that it's been slow, but that is one of them. And in our estimation, the largest producer in the world now going to see significantly increased costs based on higher taxation rates is going to influence the sellers that are producing in that country, Kazatomprom and all the joint venture companies, to raise their prices. And that's going to have a long-term influence on higher prices incoming.
Certainly. So my understanding is Kazakhstan accounts for more than a third of global supply. With this, I mean, 18% is certainly is a lot. But there were question marks as to how much they could produce anyway. Is this kind of an excuse almost not to reach those production metrics because there's question marks as to whether they really can get there? In the case of Kazatomprom, I'm thinking.
I suppose I wouldn't be surprised if they were to use this as reasoning for not quickly ramping supply. But as far as we can tell, there's no real reason for them to keep that production lower, unless, or excuse me, unless that is to say that they don't want to flood the market with pounds and put pressure on the price down. So if they can keep their assets producing for a longer period of time at slightly lower rates of production, that not only extends the life of those assets, but it increases their profit margins, because the less they produce, the higher the prices go. With all of that said, they're making an enormous amount of cash, and they're going to have to do something with that cash. So I don't know if that's going to be a special dividend. I don't know if it's going to be, they're going to have to put that money in the ground and try to prove out more resources by exploration and developing new assets, probably a little bit of both. But it's possible they might use that as an excuse. They are still building this new sulfuric acid production facility, and that keeps getting the can kicked down the road in terms of when that will be up and running. Last year, they said it'd be 2026. I think it was pretty obvious that that was never going to happen. Now they're saying 2027. I think that's even pretty optimistic. But when that is up and running and operational, they will be able to expand production. Are they going to be able to hit 31,500 tons, 81 million pounds in a single year? I think that's going to be an enormous ask, and I think it's probably not even in their best interest to hit that. So, especially because 2/3 of that production ramp comes from a very large project that's a joint venture with Russia, and the Russians have the most joint ventures with Kazatomprom, so they are going to be probably the most impacted by this higher tax regime.
Yeah, it leaves me somewhat skeptical as to how much they really will ramp up. You mentioned 31 million pounds contracted so far this year, and we're more than halfway through this year. Last year was a record for quite a while, 160 million or thereabouts. And what needs to happen in terms of the contracting for the latter half of this year? Is it likely that we're just going to kind of ho-hum our way through to the end of the year, or where's the urgency to sign these contracts, given that, as you mentioned, they're kind of being signed right at the entry point for incentive pricing for some of these developers, but the developers still have years away before they're going to produce any yellow cake, right?
Well, not only do they have years away, assuming that they are moving forthrightly towards production, but also there's a lot of projects that are, let's say, shovel ready that have not decided to begin development because A, they don't have pricing that has been, let's say, in this range for a long enough period of time, but most importantly, sufficient long-term contracts on their books to de-risk the development of that asset. So if all of the projects in the world were pushing very quickly in development without long-term contracts, a lot of those would probably go under in 4 to 5 years if we see the price spike and come back down without having contracts, right? So contracts need to be signed in order to de-risk a lot of these projects. The long-term contracting volume in our estimation is very low this year for a few reasons. The most important reason likely is that utilities have been able to flex up deliveries on legacy contracts. So contracts that were signed, let's say 2, 3, 4, 5 years ago that are being delivered on last year, this year, even into 2022 a little bit. As soon as the price starts rising, if you have a legacy contract that has a 20% flex option, you're going to flex up. If that contract is even partially fixed price, you're going to flex up, because that fixed price was probably signed at 10 or 20 or 30 or 40 or $50 a pound cheaper than the current pricing environment. So if you can have a 40 or 50 or 60% referenced to, not referenced to the market, but fixed in those contracts at 35 or 40 bucks a pound, you're going to get as much as you can. And so every utility that has had a flex option from whatever producer that offered it from a legacy contract has flexed up. So they've been able to sort of pull forward material in a way and flex up on those contracts and shore up their inventories a little bit, but sufficient to allow them to kind of step back after this historic price rise that we witnessed last year. So for the price to go from 50 bucks to 106 in 6 months is an insane move for any commodity. And it's a historical move for uranium. So if you're a utility, you're going to pull all of the levers you can in order to bolster your coffers prior to coming into a market that is so thin that when you do, it's going to move the price again. And that's kind of where we're at. The other thing that is slowing things down a little bit right now is that the United States, which is 25% of global demand for the US fleet, the biggest market in the world at this point. Chinese will pass us in a few years, but we still are. That their priority 1, 2, and 3 is figuring out waivers for Russian material. Since that legislation was passed and that gets officially signed into law, I believe 1 month from now. In fact, I think 1 month from yesterday. It's 100% priority for them to figure out if they're going to receive waivers or not for their next shipments of Russian material. That's priority 1. So they're busy doing that. It's the summertime where people generally are not at their desks, and utilities have been able to flex up. Now, the most important part of this, all of this, in my opinion, is that both the flexing up and the quiet U.S. utilities who are dealing with the Russian waiver situation, these are both temporary phenomena. As soon as the market started to shift, the contracts that were signed, when I say the market started to shift, I mean the entire fuel cycle and uranium especially were consistently moving up in price. Producers started to pull back offering those flex options. So the ability to flex up is declining. And at some point, there will not be any flex options on any legacy contracts. We get into next year, the year after, 2026, 27. Nobody's going to be able to flex up because the contracts they signed now and last year didn't have those options. So
that's what I was going to ask. How much of this capacity is left, given the contracts are pretty opaque? Do you have any idea as to how much is left from the legacy contracts, let's call them?
If we go back and look at contracting volumes in prior years, let's see, I can pull that chart up in the background here. I actually conveniently have it in front of me. Contracting volumes in the past years were relatively light. So most of the volumes that were procured by utilities were in shorter term carry trades, spot market purchasing. But we still had a few years of 70, 80, 90, 100, 110 million pounds per year. And in that declining price environment going into 2016, 17, even into 18, you had a lot of flex options offered. And those usually roll off, the average contract term delivery is somewhere in the 3 to 5 year range. There are some longer term contracts signed, but to put an exact number, I can't do that. But I can tell you that the option for flexing up is quickly diminishing. And at some point, every lever that the utilities will be able to pull, besides actually giving Cameco a call or Orano a call and saying, "Hey guys, all right, we'll take your 80 floor, 130 ceiling, let's do it." They're not going to have any other options, and they're going to have to buy when they have to buy. And every other flex option is being exhausted because this pricing environment is something that the utilities, to speak generally, there are some fuel buyers that are doing similar work to the investors, right? The investors have their own money on the line, so they want to know what the hell is going on. So they've got supply and demand spreadsheets, and they're trying to figure it all out. Fuel buyers, generally speaking, have a budget, and they buy what they need to buy when they need to buy it. It's not their job to time the market. It's not their job to predict the future. And so they are far less aware of the structural supply deficit and the supply problem that we're currently having and will have for at least another few years. They're certainly less aware than that than they are of their own personal experience in the past in their careers. And their own personal experience in the past was 07, 08. Price went from, let's say 04 to 07. The price went from $15 a pound to 134. And as quickly as it went from about 80 to 134, it fell back down into the 40s, right with the GFC. And some utilities signed contracts at 80, 90, $100 a pound. And they never lived it down. And so as far as they're concerned, this is an actual comment from the World Nuclear Fuel Market conference that I was at a few weeks ago. There was a utility representative, I'll keep him anonymous, US utility, who was saying, it's important that we maintain inventories. It's important that we support the miners, but it's also important that we don't chase price that's driven by some post on X. So he's actually blaming.
He's been following your channel clearly on X.
Yeah, thinking that I'm moving the physical uranium market, which is the most absurd thing I've ever heard in my life. So, but that's just a statement of sentiment, right? I mean, these guys think that the price is just a temporary spike and it's going to come back down, which is another reason that leads them to believe that if we hold out for a little bit longer, don't come into the term market, maybe the prices will drop. And the very, very good thing with considering that point is it's been a dead market and the market is firm. It is firm. $85 spot, 79, $80 between UXE, trade tech, term. Term keeps marching higher and the market is dead. You can hear a pin drop and the price isn't dropping. So that's going to eventually get their attention along with all of the other things I already mentioned. It's a quiet market until it's not, and it's not going to take much to get things going again.
Indeed, I'm reminded of what my uncle Rick Rule says. People's expectation of the future are set by their memory of the immediate past, and I think that these guys are fighting the last war. But barring a Fukushima or something like that, where you have all that what was demand come in as supply, it's a very, very different landscape. In terms of the supply picture, how many pounds are coming onto the market globally? If we use even 2023 as a reference point, how many pounds per year are coming onto the market, would you say, as a result of production?
This year, I'm estimating that primary production will be somewhere in the ballpark of 155 million pounds of primary mine production. You'll have an additional secondary supply that will come from primarily underfeeding, and most of that out of Russia. The Western enrichers are not underfeeding at all. That's dead. That's done. So between Orano and Urenco and Orano, that's about 40% of global enrichment. So 40% of, let's call it 25 million pounds of annual potential enrichment underfeeding. About 10 million pounds of secondary supply is off the market this year, and for most of last year as well. Russians are still underfeeding a bit. Most of that supply is remaining in Russia or being sold to the east. Some of it's still making it to the west, but So let's say 15 million pounds of secondary, which would bring primary plus secondary up to about 170 in that ballpark. And primary demand is coming simply from the burn-up rate of the world's reactor fleet at the tails assumption that we're using is somewhere in 185 to 190 million pounds and possibly even higher. That doesn't include secondary demand, which would come from financials and or inventory building. So between primary and secondary supply, primary and secondary demand, we're probably looking at about 25 to 30 million pound deficit this year. And that'll shrink a little bit next year. But the interesting thing enough is that as supply is coming online, which it is slowly, the gears are turning, and we've got incremental projects putting out a little bit of supply that are brownfield. Existing producers are trying to produce a little bit more, but the demand is growing at the same time. And the demand growth has been very tepid over the years, and that's starting to pick up. And that's not only just because of the pace of the new builds in the East between China and India, but we're seeing life extensions almost across the board in almost every country that has currently operating nuclear. And that's very positive. So demand is rising along with supply that is rising. We think we're going to see a deficit for many years to come.
Yeah, and before we move on to the whole Russia thing, with regards to, you mentioned the secondary demand, the financial demand, we've experienced a recent past where generally the term price has been higher than the spot, but we're getting pretty darn close. What happens when that changes potentially? What dynamic can that have on the market?
Well, we've had periods of backwardation, right? And that was during this bull market, let's say, if we go back to, I consider the bull market starting in about December 2020. The bottom of the commodity was in 2016, like Q4 2016, but I don't really call the turning up from extremely oversold conditions as the beginning of a quote unquote bull market. I think the bull market really started in late 2020. So in 2021, when Sprott took over Uranium Participation Corporation and activated their ATM, they were buying a lot of uranium, and the spot price went nuts, and it shot well north of the term price. Now that backwardation was taken advantage of by traders for a short period of time, and so you had what the guys from Segra referred to as a reverse carry trade. You had traders who were holding pounds that were committed to deliver to utilities that were signed in these carry trades. So it's a trader, it's not a producer, right? They didn't produce the pounds. They're buying it from a producer. They're holding it on their books. They're adding whatever their profit margin, their cost of carry, interest rates, whatever it might be, and they're signing a contract, usually a short 2, 3, 4-year contract with the utility. What traders did during this period of steep backwardation, where we saw the spot price, I think it ran into the 50s when the term price was still in the 30s, if I recall correctly, off the top of my head. I don't have the chart in front of me. Was they sold those pounds to Sprott, and then they went into the midterm market and secured a short to midterm contract with a producer, the Uzbeks or the Kazakhs or BHP, whoever it was. And so they sold the pounds they were holding that were committed to utilities, and they bought from the spot market or the midterm, let's say, contracting market. And that pulled forward a lot of demand, and it cleaned up a lot of above ground inventory. And that was one of the flexes that this market had that they don't have any longer. The carry trade is basically over. So what we have now essentially is a spot price that is about the level above the term price where it can't quite be arbed off by traders, right? Based on the interest rates. So you can't sell a spot at 86 and then go and secure a midterm contract at 82 and make any profit on it because of all of those various reasons. So that tends to put a floor under the spot price, because as soon as the spot price moves down, and we've seen this 3 times in the last few months, it hit like 82, 83, buyers stepped in because they can't buy those pounds in the term market any lower than that. And that's a really, really positive sign. We shouldn't see the spot price move below the term price in this particular instance, because the market is just too tight. It's just too tight. And there's not much flex left in the system. So it doesn't take a lot of demand. And we've seen over and over the past, especially the past year, that when there's demand in the spot market, even not even in very large volumes, the price moves. There's just not a lot of supply there.
It's very interesting. And sticking with the spot market, what happens when, is there such a scenario where the spot just runs out as such? So if, let's just say the Sprott vehicle and Yellow Cake or whoever else is out there buying up some of the physical, what happens when they reach a premium to their NAV and so they can issue units to go out and buy more uranium, but there isn't much uranium to buy?
Well, we haven't yet encountered that. Technically, I believe, according to their prospectus, Sprott can go further out onto the curve for delivery, out to 12 months, is my understanding. Now, as of yet, I don't believe they've gone further out than 3 or 4 months in the forward curve. So they could potentially go out that distance. Like I said, we haven't crossed that bridge yet, but we haven't seen a market that is so tight that there's literally no supply at any price for any deliverable period. I'm not in the camp that we're going to see that, but very, very intelligent people that I highly respect do believe that we're going to reach a panic moment when a utility will not be able to get the material. That was actually a comment from one of the reps from UXC at the same conference. Somebody was asked if they believe that the price will be, one of the utility reps was asked during a Q&A session if he believed that the price would ever reach a high enough point that it would inhibit their ability to fuel their reactor. And he just said, no, I don't think so. And Jonathan Hinsey from UXC basically picked up the mic. He wasn't asked the question, but he just turned his mic on. And he said, it's less likely that price is going to keep a utility from being able to get their material than it is an utter lack of fuel. And they just dropped the mic.
What percentage of the utilities cost is represented by the cost of the Yellow Cake itself? It's still de minimis, right? Even in the rise.
It's very small. Uranium standing alone, uranium is only, let's say, 4 to 6% of their overall operating costs. But uranium doesn't exist in a bubble. We've got record high prices for conversion. We've got if not decade high prices in enrichment. So everything in the fuel cycle has gone up and their fuel costs have gone up. But at the same time, especially in the US, utilities are killing it right now. They're making a lot of money selling electricity, and they can see the writing on the wall with this rising demand situation with data centers and AI, that they're doing everything they can to have uprates in their electricity generation, and potentially even building new reactors, life extending their reactors. Every single utility in the US is going to try to life extend their reactors. That's pretty much across the board. So, but it was very interesting to see the utter lack of concern by utilities at the conference. And I think that impatient investors will be like, well, what the heck, man? We've got this supply deficit. When are these guys going to wake up and come to the table and buy so I can sell out? At the same time, for me, I'm going to go to one of these conferences probably a few years from now, and there's going to be a sense of panic in the room. And that's probably going to be more of a sign of reaching near the end of this thing than it is that there's a lot of room to run. They're not worried, and they should be.
Interesting. And with regards to the Russian ban or ban on enriched Russian fuel, when it's going to be signed in next month, when does it actually come into effect? Because there's often a delay or a lag period.
No, it was already signed. It
Okay.
was signed back in May. Actually, let's see, it passed the Senate on April 30th. It was signed in May, and then it was a 90-day period. So it becomes law, I think it's August 14th, if I recall correctly.
Yeah.
But the curious thing is that 10X, which is the Russian Enrichment Corporation, state-owned corporation, issued essentially a warning to the US utilities right after this went into law, or right after it was signed, excuse me, because it's not into law officially yet, basically giving US utilities 60 days from that announcement to procure waivers, because they wanted even more heads up. They don't want to ship material to the port, send it on a ship, send it across the ocean, only to have it returned to them, right? They don't want to go through that process. So not only did they want the waivers up front, but they wanted payment up front as well. They didn't want to get caught with their pants down, sending material, having it been sent back, having to foot the bill for all of that. So, and I don't know where that's landing because I'm pretty sure that 60-day period is basically right now. So to my understanding, I haven't heard about any waivers actually being granted yet, though it was the assumption at this conference by people that are close to DC that waivers probably will be granted for the first, maybe the second shipment of material where it could be, a case could be made that it was a dire need for those deliveries. Utilities don't want to pay. If they have to come in and buy spot EUP, they're going to be paying 2 or 3x, maybe more than what they would have paid in a contract signed years ago for EUP being delivered right now. So it's very, very important to them that they do everything they possibly can within the allowances of this legislation, this new law, to have waivers for these next deliveries. With that said, it's 100% illegal across the board to import material from Russia starting in 2028. And that's tomorrow in the nuclear world. And I've already spoken to a fuel buyer who is already basically on the horn with the Russians to sign something for 2040 delivery when the law comes out of effect. That's how far ahead they're thinking about procuring, because they see their fleets de-risked so significantly by this rising electricity demand situation that I've already heard, even before speaking to this person, I've heard of enrichment contracts going into the 2040s already. Yeah.
Okay, so that leaves me with two questions. The bottleneck seems to be around enrichment. What can the US do or what can the West in general do to improve their enrichment capacity? And on a technical note, does it matter if there's a change of government in the US, or once this Russian ban's in law, it's in law basically, and that's it?
It'll remain in law if there's a party change or a president change, let's say, in the United States come November, or I guess come January. So the law becomes law in 30 days, and it'll remain, following that. So what can the West do? Well, the West is slowly expanding enrichment capacity. Urenco and Orano are both expanding enrichment capacity, not expanding it a lot. Urenco has stated that to some extent, their expansion is going to be replacing older centrifuges that are going to have to come offline at some point pretty soon. We also have the funding from the act that was passed with this Russian ban legislation that unlocked this funding. This is 2.7 billion in funding to support domestic enrichment. And that is currently an RFP that has already been put out by the Department of Energy that is awaiting responses. And technically, who can respond? Urenco, who is not actually an American company. It's owned, I believe, by UK and the Dutch and one other entity off the top of my head. But they have a facility in the United States. So Urenco, Centrus, and potentially GLE, which is the Silex laser technology, may or may not respond to this RFP. So that's out there right now. So the government's saying, hey, we'll put up some cash to incentivize you guys to expand production to try to meet this challenge. This is a little bit of an interesting situation because the converters and the enrichers don't really love the government funding piece, because what has happened in the past, there was actually government supported conversion in the past. The government bought up a bunch of conversion. And then what did they do after they supported it? They sold UF6 back into the market, and that lowered the price and hurt and was one of the elements that led to the difficulties in the conversion market that led to ConverDyn shutting down. So the guys at ConverDyn are like, they're over it. The rep for ConverDyn that was up on stage at this conference, you could see his frustration, because all anybody is ever asking him, he gets this question every freaking day, seemingly, is what it sounds like, is, when are you guys going to expand? Conversion is such a bottleneck in the West. When are you going to expand? And he's going, how about you guys stop buying enrichment from Russia and China and then give me a call? Like, he's pissed at the utilities because they haven't contracted enough at high enough prices to get them to expand. So shut up and stop asking me to expand. You want us to expand? Bring your checkbook.
Okay, interesting. So this may be oversimplification on my behalf, but essentially, if this thing's permanent, that is a big giant wedge between the US, the rest of the world, and let's call it the East. And that's not likely to change until, who knows, 2040. And then at the same time, you guys are not really doing an awful lot in terms of encouraging domestic, what would be considered domestic conversion and enrichment, which are really the main players there are companies that are not US owned companies.
The Urenco is not US owned, but they do have a facility in the US and they're friendly to the US and they do have the ability to respond to the RFP for enrichment. Yeah, and the converter Converdyne is a US company. They're owned by Honeywell.
Yeah.
I mean, who knows? We could see them expand if we see some more contracting volume, and it certainly would be helpful to have more conversion. It would be helpful. But at this point, because the utilities haven't contracted more with Urenco or excuse me, with Converdyne or Orano for conversion, they haven't announced big expansions. I believe Orano is slightly expanding conversion, but it's years away. So conversion, Converdyne can expand much faster and much cheaper than anybody else, but they're not going to do it unless and until they have higher priced contracts and enough volume.
You guys don't want people having too much fun, do you? By the sounds of it, you're not making a lot of friends. Well, let's transition into equities. We've got the price rising in the spot. The equities, at least as defined by the URA index, has basically kept pace, no more over the last year and even 5 years. What's going on in terms of the equities? I'm looking at, I guess, the bellwether Cameco, and I don't know, for a value degen like myself, paying 33 times 25 estimate of cash flow, 5 times book, and the analysts are really expecting an awful lot of growth for this company. How do you see the equities in relation to the spot market, the material itself, and how do you see the growth rates for a lot of these equities? Are they realistic in terms of what's being priced in currently?
It's hard to say. I think that there's overvalued and undervalued uranium mining equities right now at $85 a pound. How many equities in the space are pricing in the likelihood of a significantly higher and sustained higher uranium price? I would argue very, very few. So if you believe that we are going to see $150 to $200 uranium, possibly higher in the next 2 or 3 years, I would argue that the equities are very, very cheap here. If you believe that we're going to remain at $85 to $100 uranium in perpetuity, some of them are overvalued. Cameco is a little bit in its own world because this is not just a uranium mining company, and it never has been. They've had conversion and fuel fabrication for quite some time. Fuel fabrication now with Westinghouse, excuse me. They've had conversion for quite some time in addition to uranium mining. Now with the Westinghouse acquisition, they have fuel fabrication and they have participation in the maintenance and the construction of nuclear power plants. I honestly think in hindsight, that acquisition was unbelievably brilliant. And I don't think the market fully yet understands the potential. I don't even understand the potential. I think it's an incalculable upside for the company. And that's probably why the valuations seem lofty here. Because if you just look at their uranium book, which looks very good, they've got a lot of pounds in the ground. They've got more brownfield assets in the United States at Rabbit Lake. They have expansion potential at MacArthur. The uranium mining side of things looks good. They've got a lagged exposure to rising prices because of legacy contracts that were signed. You can see that in their quarterly reporting. The realized prices are well below the existing pricing environment, but that's going to go for any company that signs long-term contracts. But they seemingly signed more at lower prices, and let's say Kazatomprom did because they have a higher realized price, right? Also lower production costs. But they've got this other sort of X factor with Westinghouse. And if we end up seeing a quote unquote true nuclear renaissance that is being promoted by various countries, at the COP28 last year, 20 something countries signed a pledge to triple nuclear by 2050. I mean, if we get halfway to that goal, Westinghouse is a moonshot. And so this could be an absolute boon for the company. And I don't think anyone really knows how to value that potential here.
What about the guys that don't have any production? What about the guys that are discounting, let's say, generous estimates of the pounds in the ground? How many of these guys are actually going to get into production over this cycle?
Very
Or
few.
do we really need like $150 uranium in the terms, like being signed for these shitco's to actually get some yellow cake out of the ground?
No, they're certainly not needed. But I would say the appearance of 75 companies in the last 2.5 years is a sign that the industry is recognizing a bull market, right? So it's fully here. The bull market is here. This is not a contrarian setup any longer, unless you believe that we're going to much, much higher uranium prices and the equities aren't pricing that in yet. But to your point, we have absolutely not seen the mining stock fervor that can happen in raging bull markets where anything with uranium in its name goes to some nutty valuation. We haven't seen that yet. And I think we will see that probably in the later innings of this investment. But it's very difficult to say when that is. So much has happened in the last 24 months that this investment has been a moving target. If you had asked me in 2019, are we going to reach an exit, a price spike and or an exit point by 2025? I would have, and I probably did say absolutely. Absolutely. This is a 3 to 5 year investment. I've been saying that for the last 3 to 5 years. Okay. This has been a moving target. Nobody saw this nuclear renaissance coming. The AI situation came out of left field and is surprising even the utilities. There's reports, was it Constellation? All the utilities are putting out similar numbers in these quarterly reporting where they're saying just 2 years ago, their estimations of electricity demand going out to 2035 was single digit growth, and now they're expecting it to double. That happened over the last 2 years. So this is a huge new trend that's highly, highly supportive, especially of existing reactors being life extended. That's the number one benefactor of this AI boom for nuclear. And whether or not we're going to see new builds in the West substantially pick up pace remains to be seen. India and China are going balls to the wall, but we have yet to see new build announcements in the United States, but I think they're coming. And it's hard to say when this investment is going to, let's say, end, when we're going to see an actual bona fide oversupplied market to the point where we see the price come down relatively quickly and steeply. The only other option for that is a demand shock, which is always possible, but it's looking pretty unlikely right now. So I don't even remember what your question was, Benjamin. I apologize, but
It was more around some of the juniors and their incentive, what their incentive price might be in order to realistically come to production, given everything that needs to happen from the final investment decision to having the pounds signed at prices that allow them to do that. But in terms of the AI thing, yeah, I guess it's here to stay, isn't it? So I guess that really is a demand factor in terms of new builds for nuclear. In the meantime, very, very interesting with natural gas prices so low in the US, one would think that that would be I guess, the immediate beneficiary in terms of um, input for power generation and then eventually being replaced by something like nuclear, a little more permanent. Is that a fair summary from the way you see things?
I would say that's highly likely. Yeah. I would say that the extension of the existing fleet plus a fast build out of natural gas is probably going to be the near-term solution for this energy demand growth. But there are most utilities when they most recently were polled by UXC are interested in building new nuclear. And many utilities in the United States already have permitted sites with an existing nuclear reactor where they can build another reactor.
Okay.
Without going through the permitting process, especially if it's an already approved design like the AP1000. And some of these SMR designs, that's also a potential. There's multiple utilities looking at SMRs, but there's also tech companies and crypto companies that are interested in engaging directly with the nuclear builders, not necessarily with the utilities. And I don't think the industry wants that. I think the industry wants to see collaboration between the tech companies and the utilities and the nuclear and the contractors or the designers building these things. But I have a feeling that if the utilities don't step up fast enough, the tech companies are going to get theirs however they need to. And I think it's very interesting to see TerraPower breaking ground in Wyoming. They're already doing site preparation, the non-nuclear aspect of construction. That permit was granted by the NRC, despite the fact that the design permit has not been granted yet for that design. But they're expecting that it will be, and they're willing to take on the financial risk. Yes, that's a demonstration project with some funding from the DOE, but there's still a lot of financial risk, and the tech companies are like, hold my beer, let's do it. I don't care if there's going to be cost overruns. I'm swimming in cash and I need the power. So let's get it done. And so we're at this really interesting point right now where we're not exactly sure how this is going to play out. But the tech companies are moving fast. They're buying up land in Northern Virginia. They're working directly with the power suppliers to secure a future supply from existing nuclear plants. And they're starting to work directly with the actual nuclear builders. So and the companies that are designing, the SMR companies, the Oklos and the GE Hitachis, et cetera. Very, very exciting and interesting time. Not exactly sure how it's going to pan out, but the rising demand growth for electricity is happening here. It's happening in Japan. It's happening in the UK. It's happening in China. Of course, it's hugely happening in India. India is announcing, increasing their fleet almost every 2 or 3 weeks. We see another announcement of them adding another few reactors to their plans. So it's really moving quickly right now.
Yeah, I think that's a trend that's going to surprise a lot of people. I think that's far more likely and far more imminent than people realize, because these companies obviously rely on electricity. Without that, they really don't have a technology company. And if you're saying, which I didn't realize or appreciate, if you're saying there are quite a lot of sites already with the permits, they don't have to reapply for a permit to build these things out. I think that you could certainly see some kind of JV with a private tech company saying, hey, well, we've got the cash, we can fund the generation of this thing, in addition to some kind of agreement later where they can fund their crypto mining or tech company, whatever the case might be.
I think that would make a lot of sense. I really do. Yeah. The utilities standing alone, let's say, are most concerned about cost overruns. They want some kind of backstopping from the federal government. And the federal government is kind of like, we've given you a lot the last couple of years between the Inflation Reduction Act, these clean energy production tax credits. You've got clean energy, not production tax credit, investment tax credits. If you grow your fleet, you've got all these benefits, and they're saying, we need more. We need more backstopping. We need some protection for the overruns and cost. So I think, like you mentioned, the joint venture between the tech companies is highly, highly likely, and makes a lot of sense. I don't want you to think I'm skirting around your question about incentive pricing. So let me just answer that really quick.
Okay.
Incentive pricing is only one problem. And you could argue that there's certainly a handful of development companies that have yet to put a shovel in the dirt that this pricing environment will work for them according to their feasibility studies, right? But why aren't they developing yet? Well, they need long-term contracting on the books, or they need financing. And most of these companies are not going to build out a mine that's going to produce 3, 4, 5 million pounds a year and not have contracts, at least some contracts on the books to de-risk that investment and the headache of doing that. Nobody wants to build a mine. Mining sucks. Nobody wants to do this. It's very, very, very hard. Even the biggest established producers right now have constant challenges. We're talking about Kazatomprom and Cameco, okay, Orano. Oh my gosh, Orano is hitting all sorts of headwinds in Niger. They're hitting headwinds in Mongolia. Now they've got this increased tax regime in Kazakhstan. I mean, everywhere they turn, they're seeing production problems. So looking at Cameco, the ore grades coming out of MacArthur and Cigar, but we'll use MacArthur for this example, they're changing all the time. Operating that mill is not just flipping on a light switch and dumping a bucket of dirt in there and yellow powder comes out the other end. It's unbelievably complicated. And it takes very, very skilled people to do it. It's going to take them years and a lot of investment to take MacArthur up to that nameplate, which I believe is 24 million pounds a year for Key Lake. So, and then you have Kazakhstan. I mean, the sulfuric acid problem, skilled labor problem, the infrastructure problem, getting trains from away from the war effort in Russia to bring sulfuric acid over, getting crane operators, drill operators, insufficient supply they have to continuously establish well fields. It is very, very difficult to mine uranium. And the assumption that all of these projects are just going to come on when we hit that incentive price is so naively optimistic that you have to expect that most of them are never actually going to produce. And the ones that do, it's going to take many, many years for them to get into production. So we think the production expectations for the next 3-4 years coming from certain models that we've seen are extremely optimistic. And we think we have multiple years to go before we even see a point in time balanced market, because you have to consider existing mines also have depletion rates, right? You've got phase 1 of Cigar is going to be depleted in the next few years. They plan to go into phase 2 with the plan of maintaining an 18 million pound of production per year, but the mining does get more difficult, more complicated, lower grades in phase 2. There's multiple other mines that are going to be depleting over the time. A lot of mines in Kazakhstan are set to deplete between 2030, 2035. So if we have NextGen's Arrow, Denison's Phoenix, Global Atomics DASA, Langer Heinrich is at full production, BHP gets another couple million pounds, the Uzbeks get another couple million pounds, few million pounds out of US ISR, million pounds out of Honeymoon, maybe Mulgarock, maybe one of the Namibian projects. Let's say all of that happens by 2030. Then in our estimation, we reach a point where the supply basically meets demand for a year or two. And then it just does this again. So it's going to be very interesting to see how this all pans out.
Yeah, a couple of comments.
And that's at any price, Benjamin. Sorry, that's at any price.
Exactly. And I think that, I mean, what the feasibility studies look good on paper, and they were also done quite a few years ago when the world was just a little bit different. And the practical problems in which you encounter in terms of getting to this situation where you're producing, I think is something that we're all probably underestimating. So this has been fascinating. Anything else you'd like to leave us with before we wrap it up? Anything I missed that's a pertinent question that you'd like to address while you've got the chance?
Parting thoughts. We expect a pretty eventful second half of the year. We think that a single large RFP or a single large term contract being signed is going to kick the market into gear in a similar way that we saw last year. And that could happen tomorrow, it could happen next week, it could happen next month, but it's going to happen. The levers that utilities have been able to pull to avoid coming into the term contracting market in high volumes, they're running out. They are temporary, and they cannot pull on those levers forever. So something is going to kick it into gear. Last year, that was 2 decently large RFPs. The first one was earlier in the year, March, April, if I recall correctly, from PG&E after they officially were able to extend Diablo Canyon in California for 5 years. They came into the market with a big RFP. And what that did was it showed how thin the market was. How did it do that? Well, you didn't have very many people respond to the RFP, and it took a while to get filled. Then at 3 or 4 months later, the Koreans came into the market with another big request, and the Koreans' RFP actually had price dictation. So where PG&E would say, we need this many pounds to be delivered over these years, give us your offers. The Koreans said, we need this many pounds delivered for these years, and this is what we're willing to pay. And it was not filled. And to my understanding, it still hasn't been filled. So the Koreans still need to come into the market. And unless they change how they negotiate their contracting needs, they could be negotiating off market. I don't know. Probably not coming back into the market with a similar style RFP at this point, especially at $30 higher, $35 higher than it was at the time they did this last year, right? So something is going to come into the market, and the market, I've said this before, where we have a market that is fragile enough that you can have high confidence that something is going to break it without needing to know what that something is. And this often happens in this market where something comes totally out of left field that absolutely nobody predicted. That happened last week. Kazakhstan taking their tax rate for uranium production from a flat 4% to a progressive tax all the way up to 18%. And there was an additional up to 2% addition on top of that progressive tax that had to do with their realized price, their profit margin. So if you have a realized price above $70, $89, $100 a pound, you have an additional 1-2% added onto that progressive tax. That came out of nowhere last week, and that has significant implications for this market. Nobody saw that coming. Nobody predicted that. So when you have a market that's very, very fragile and undersupplied, just know that something is going to break it. And you don't even have to know what that is going to be. But in the near term, we expect a large term contract and or a large RFP is going to hit, and that's going to do two things. It's going to show how thin the market is again, and it's going to show justification to all of the fence-sitting utilities that this pricing environment is real. It's not dropping back down to the 50s. And if you have needs, you better get them taken care of, and you better do it soon. And that's what I think is coming for us, likely as soon as the second half of this year and into years to come.
Makes sense as a catalyst. Wrap up. Tell us about the Uranium Insider and the options available for people who would like to learn more about this market and your investment thesis.
Sure. I'm just realizing right now, 2 weeks from now is our 5-year anniversary. 5-year anniversary is August of this year. So it's been quite the labor of love. We have a significant team built up at this point. All we do is analyze this market and put a lot of focus into the physical market. We want to know what's going on behind the scenes, who's buying, who's selling, at what price, and what volume. And so we put a lot of effort into that. We make sure that our members are up to speed on those changes, and they know when things change in the physical market. That's priority one for us. We've outperformed the market significantly since inception. We've outperformed the ETFs, including dividends, by almost a factor of 2 since 2019. So we're very proud of those returns. We're really excited about this market. The catalysts that have come forward of the past 24 months are absolutely unbelievable. Every month when we sit down and write the newsletter, we almost are pinching ourselves. Like, we get super bullish at the end of each month as we're writing the next month's letter. It's like, can you believe this? All of these countries are life extending. All of these countries are building. Look at this pricing environment. It's extremely undersupplied. The price reporters are sending out warning flares to the utilities. They're just like, hey guys, this is a problem. You got to step up. It's truly remarkable what has transpired. And so we're quite bulled up. We're happy to have a little bit of a quiet summer. It's nice to just spend multiple days kind of turning off the screens, keeping an eye on the physical market, but not being glued to the screen. I think is healthy to take a break once in a while. And it's quiet until it's not. And so enjoy the quiet. Accumulate when you see the RSI go below 30. Just relax. It's a bull market. Buy the dips and hang on for dear life, because it does get wild, and it will get wild. And that moment that we were talking about a minute ago of when all of the you called them shitcos, all of the small cap exploration companies that don't really have great assets, and there's dozens and dozens of them in the uranium space right now. There's hundreds in the gold space. But at some point in a resource bull market, everything catches a strong bid and the sector goes nuts. And we've had one very short period of that in this bull market, despite the fact that the sector has generally moved from the bottom left to the upper right, along with the spot price. We have yet to have a very rip-roaring, long-term, crazy bull market. And that's coming. I'm not saying it's coming tomorrow. I'm not saying it's even coming this year, but we will have that moment in this market at some point.
Yeah, very fascinating to see it all play out. Thank you very much for your time, guys. Links to Justin's newsletter will be in the description. Take care, guys. Do your own due diligence, and I look forward to catching up with you in another episode of the ROI podcast later.